The investing app sitting on your phone right now, the one you used to buy your first stock, is quietly routing your idle cash through a decentralized finance protocol most people have never heard of, promising around 7% a year on a dollar-pegged coin. No bank branch, no loan officer, just code. Today, we're pulling back the curtain on exactly how that works, what DeFi lending and compounding actually do to your money, how Robinhood partnered with a protocol called Morpho to build this, and what the real risks are that the headline APY doesn't mention. By the end of this episode, you'll be able to read one of these yield products and actually understand what's happening underneath it. I've got someone here who has been deep in this material, so let's get into it. Walk me through what we're actually dealing with.
So the place to start is what DeFi actually is, because the word gets thrown around a lot and it means something very specific. Decentralized finance is an alternative financial system built on a permissionless blockchain. The key word is permissionless. Anyone with a wallet can participate. No credit check, no geographic restriction, no institution deciding whether you qualify.
So it's basically finance without the gatekeepers.
Exactly. And the way it works mechanically is through smart contracts. These are self-executing pieces of code that automate what a bank would normally do manually. Instead of a loan officer approving your loan, a smart contract does it instantly based on rules written into the protocol.
And that's what makes it decentralized. There's no human in the middle making the call.
Right. Now, the lending model in DeFi is fundamentally different from traditional banking too. In traditional finance, a bank matches a depositor with a borrower behind the scenes. In DeFi, you deposit into what's called a liquidity pool, a shared reserve aggregated from thousands of users, and borrowers draw directly from that pool. The yield you earn comes from the interest those borrowers pay.
So I'm essentially becoming the bank.
That's a clean way to put it. You supply the capital, borrowers pay interest, and that interest flows back to you. And there's actually a term researchers use for how these protocols connect to each other. They call it composability. A Chulalongkorn Business School paper on decentralized lending described DeFi money as Lego money, because smart contracts and tokens can be snapped together across protocols without asking anyone's permission.
Lego money. I love that. So what does that mean in practice?
It means a single product can layer multiple protocols on top of each other. Your deposit might flow through a vault, get allocated across several lending markets, and generate yield from multiple sources simultaneously, all automated. Which brings us to the compounding piece, because that's where things get genuinely interesting.
Okay, compounding. Everyone knows the concept from a savings account. Your interest earns interest. But you're saying DeFi does something different with it?
Dramatically different. A traditional savings account might compound monthly or quarterly. DeFi auto-compounding protocols can reinvest rewards every few minutes or hours through smart contract automation. According to a CryptoQuant analysis from August 2025, these protocols monitor positions continuously and execute reinvestment transactions when conditions are met, like when accumulated rewards hit a threshold or when gas costs are optimized.
Wait, so instead of compounding 12 times a year, you could be compounding hundreds of times?
Potentially thousands of times, depending on the protocol. And the same CryptoQuant piece points out that the power of compounding is further amplified because you can combine multiple yield-generating strategies in one protocol: staking rewards, liquidity provider fees, trading fees, governance token distributions, all reinvesting into each other simultaneously.
That sounds almost too good. Like, where's the catch?
We'll get there, and it's a real conversation. But first, let's ground the scale of what we're talking about. According to the Blockchain Council's DeFi and Digital Assets report from July 2026, DeFi Total Value Locked, TVL, which is essentially the total assets deposited across all protocols, was roughly $71.77 billion as of June 18, 2026, based on DeFi Llama data. And lending protocols specifically account for about 20 to 30% of that.
So we're talking about tens of billions of dollars sitting in these lending pools.
And that same report notes DeFi peaked at $177.48 billion in November 2021. So it's come down from that peak, but it's stabilized. This isn't a fringe experiment anymore.
Okay, so that's the landscape. Now let's talk about the thing that actually made me want to do this episode, Robinhood. Because on July 1, 2026, something pretty significant happened.
Yeah, July 1st was a big day. Robinhood launched two things simultaneously: Robinhood Chain, their own blockchain, and Robinhood Earn, a decentralized lending product offering an estimated 7% APY on a stablecoin called USDG. And the engine powering it is Morpho, an open blockchain-based credit network.
So Morpho is the actual infrastructure, Robinhood is the front door.
Exactly. And Paul Frombo, the co-founder of Morpho, said it directly in the Business Wire announcement. Decentralized finance technology works best as infrastructure, allowing brands and institutions to offer products that are more open, more transparent, and more competitive than those built on traditional financial rails.
So walk me through the actual flow. A user opens the Robinhood app, taps Earn. What happens to their money?
So, according to the TrustSwap team's Robinhood Chain Lending Guide from August 2026, here's the verified chain of custody. The user deposits USDG, that's the dollar-pegged stablecoin, from Paxos's global dollar network. That USDG flows into a Morpho vault on Robinhood Chain. The vault is curated by a firm called Steakhouse Financial.
Steakhouse Financial. That's a name.
It is. They're the ones deciding how the vault allocates capital across Morpho markets. Then the vault lends that USDG out to borrowers who are sourced through protocols including Spark, Athena, and Maple. Those borrowers put up collateral to borrow USDG, they pay interest, and that interest flows back to the depositors as yield.
And the settlement layer for all of this is Robinhood Chain itself.
Right. And Robinhood Chain, per the TrustSwap guide, is built on Arbitrum Orbit, uses ETH for gas, and went live July 1, 2026. By early August 2026, stablecoins on the chain had already reached roughly $575 million.
$575 million in about a month. That's not nothing.
Not at all. And Morpho itself is already a major player. DeFi Llama listed Morpho's TVL at about $7.07 billion as of a July 2026 snapshot, according to the Crypto Daily analysis by Maya Sinclair. So Robinhood isn't partnering with some tiny startup, they're plugging into one of the largest DeFi lending protocols by deposits.
And Hood, Robinhood's stock, actually moved on this news, right?
It did. According to the Crypto Daily piece, Hood popped roughly 5% intraday when the news hit. Whether that's sustained value creation or just a sugar high is a separate question, but the market noticed.
Okay, I want to push on something here, because 7% APY on a stablecoin sounds incredible compared to what a savings account pays. But is that number real? Is it guaranteed?
It is not guaranteed. The Crypto Daily analysis is very clear on this. It's an estimated 7% APY, not a fixed rate. Morpho operates as an open network where lenders and borrowers compete in real time, which is what helps create more efficient markets, but it also means rates fluctuate based on supply and demand dynamics in the pool.
So if a lot of people pile in and supply goes up, the rate could drop.
That's exactly how it works. And Galaxy Research's September 2025 paper on on-chain yield, written by Christopher Rosa, frames this really well. They say you should read every headline yield number through two lenses, what you earn for the risk and what remains after the work involved. The 7% is the headline. The risk-adjusted number is what actually matters.
So what are the actual risks sitting behind that number?
There are a few categories. The first is smart contract risk. The entire system runs on code, and code can have bugs. If there's a vulnerability in a smart contract, funds can be drained. That's not theoretical, it's happened across DeFi multiple times.
And there's no FDIC insurance on this?
Correct. Though, interestingly, the TrustSwap guide notes that the Robinhood Earn product does carry insurance arranged via Lloyd's of London and Realm, which is notable. That's not standard across DeFi, that's something Robinhood specifically arranged for this product.
Okay, that's actually reassuring. What else?
Stablecoin risk. USDG is a dollar-pegged stablecoin from Paxos's global dollar network, and the fundamental promise of any stablecoin is that it stays pegged to the dollar. But that promise depends entirely on the quality and transparency of the reserves backing it, and we have a very vivid cautionary tale here.
Terra USD.
Terra USD. In May 2022, Terra USD, an algorithmic stablecoin, lost its peg and wiped out tens of billions in value. The stablecoin regulatory analysis from late 2025 describes it as a stark reminder of the risks associated with poorly collateralized or conceptually flawed stablecoin designs. USDG is a different design, it's fiat collateralized through Paxos, but the lesson about reserve transparency is universal.
So the design matters enormously. It's not just stablecoin equals safe.
Not at all. And then there's liquidity risk. What happens if a lot of people try to withdraw at the same time and the pool doesn't have enough liquid assets to cover it? And finally, regulatory risk. The 2026 regulatory outlook from Kryptonium describes 2026 as a potential inflection point where regulatory frameworks are starting to crystallize around stablecoins and DeFi protocols.
And Robinhood Earn is US only right now, which suggests they're being careful about that.
Yes, and that distinction the Trust Swap Guide makes is really important. Robinhood Earn is US only as an app product, but Morpho itself is a permissionless protocol. Anyone with a wallet can interact with Morpho markets directly, outside the app. So the regulatory perimeter around the Robinhood product doesn't contain the underlying protocol.
That's a really interesting tension. The app is regulated, the infrastructure underneath it isn't, or at least not in the same way.
And that's actually the broader story of what's happening in DeFi right now. The Blockchain Council's July 2026 report puts it well. DeFi has moved well past simple token swaps. Lending markets, staking derivatives, tokenized real-world assets, and yield vaults now form a multi-chain credit system with real liquidity, real borrowers, and very real failure modes.
Real failure modes. That's a phrase that should be in every product disclosure.
It really should. And here's a number that I think puts the whole thing in perspective. According to the Blockchain Council report, stablecoin circulating supply was about $314 billion as of mid-June 2026. Total DeFi TVL under some estimates is a fraction of that. So there is an enormous pool of digital dollar liquidity that is still sitting outside DeFi lending risk.
So either people aren't convinced yet, or they don't know the option exists.
Both, probably. And that's exactly why the Robinhood Morpho partnership is significant. Gaetan Thabot, director of partnerships at Robinhood Crypto, said in the Business Wire announcement, "We believe everyone should have access to the most efficient and innovative financial tools available." That's a direct pitch to the people who have stablecoins sitting idle.
And Morpho's co-founder framed it as DeFi working best as infrastructure, invisible to the user, powering the product.
Which is the most interesting thing about this whole story to me. Millions of Robinhood users are going to interact with Morpho's open credit network without ever knowing the word DeFi. They'll just see a yield number in an app they already trust. That's a level of mainstreaming the space has never seen before.
It's DeFi wearing a fintech costume.
That's exactly what it is. And the research from Chulalongkorn Business School on decentralized lending is worth citing here because it shows who actually uses these protocols. On-chain transaction data from Compound, one of the early DeFi lending protocols, showed that loan durations are short, averaging 31 days, and many users borrow to support leveraged investment strategies like yield farming. So the borrowers on the other side of Robinhood earns deposits are often sophisticated actors running strategies.
So the everyday Robinhood user is essentially providing liquidity to crypto-native traders running leverage strategies. That's a wild dynamic.
It is. And the same Chulalongkorn paper notes that systemic risk in DeFi arises from concentration and interconnection, and that traditional risk management practices can be challenging to apply in this environment. That's the academic version of, this is complicated and the old playbook doesn't fully apply.
Okay, I want to zoom out for a second, because we've been talking about Robinhood and Morpho specifically, but the Galaxy research paper from September 2025 had this framing I thought was really sharp: yield at a crossroads between banks and blockchains. What does that mean for someone trying to make a decision about where to put their money?
The Galaxy paper by Christopher Rosa frames it as a ladder. At the bottom, you have non-yield-bearing stablecoins. They're engineered for stability and fast settlement, not income. Then you climb up through platform-dependent yield, staked stablecoins, lending and borrowing, structured yield products, and at each rung, complexity and risk increase. The point is that you can't just look at the APY number. You have to understand where on that ladder you're standing.
And Robinhood Earn sits somewhere in the middle of that ladder.
It does. It's a curated, managed vault product, which is more structured than raw DeFi lending, but still carries the underlying risks of the protocols it's built on. The curation by Stakehouse Financial is meant to manage those risks, but it doesn't eliminate them.
And the insurance through Lloyd's of London and Realm is a layer on top of that.
Right. Which is genuinely unusual for a DeFi-adjacent product. Most protocols don't have that. It suggests Robinhood is trying to bridge the trust gap between traditional finance users and DeFi infrastructure.
Let me ask you something that I think a lot of people are wondering. Is 7% on a stablecoin actually sustainable? Or is this one of those things where the rate is high now because the product is new and it'll compress over time?
That's the right question to ask. The Crypto Daily analysis by Maya Sinclair is pretty direct about this. The 7% is not fixed or guaranteed. It's an estimate based on current market conditions. As more capital flows in and supply increases relative to borrowing demand, the rate will likely compress. That's just how market rate lending works.
So get in early if you want the best rate.
Potentially. But the flip side is that early adopters also take on more uncertainty. The product is newer, the track record is shorter, and the regulatory picture is still forming. The 2026 regulatory outlook describes this year as a pivotal moment where frameworks are beginning to crystallize. That's not a threat exactly, but it's a variable that could change the product significantly.
And there's the competitive pressure angle too. If Robinhood can do this with Morpho, what stops every other fintech from doing the same thing?
Nothing, really. The Morpho co-founder's quote is telling. He said, "Morpho now serves as core credit infrastructure for some of the most widely used retail financial platforms in the United States. Plural. Robinhood isn't the only one. And because Morpho is a permissionless protocol, any platform can build on top of it. The competitive moat is in the user experience and the trust, not the underlying technology."
So the race is really about who can make DeFi feel the most like a normal app.
Exactly. And that's a very different competition than the early DeFi era, where the race was about who could build the most sophisticated protocol. Now it's about distribution and trust. Robinhood has both, millions of users who already trust the app with their investments.
So when you step back from all of this, the compounding mechanics, the Morpho vault structure, the 7% number, the risks, what does this actually mean for someone sitting at home with some cash they want to put to work?
Here's what I think it comes down to. DeFi compounding is real, and it's genuinely more powerful than what traditional savings products offer. The frequency of reinvestment alone is a structural advantage. But the yield doesn't come from nowhere. It comes from borrowers paying interest, and those borrowers are often running leveraged strategies. When markets are calm, that works. When they're not, liquidity can get stressed.
So the yield is a function of the risk on the other side of the trade.
Always. And the Galaxy Research Framework is the most useful tool here. Read every yield number through two lenses: what you earn for the risk and what remains after the complexity. Robinhood Earn has done a lot of work to reduce the complexity for the average user. The risk is still there, it's just been packaged more neatly.
And the insurance through Lloyds and Realm is a real differentiator. That's not something you get if you go interact with Morpho directly.
Right. The Trust Swap Guide makes that distinction clearly. The app product and the open protocol are two different things. If you use Robinhood Earn, you get the curated vault, the Stakehouse financial risk management, and the insurance layer. If you go directly to Morpho with a wallet, you get more flexibility, but none of those guardrails.
And the regulatory picture is still evolving, which means the product itself could look different a year from now.
That's the honest answer. 2026 is being described as a pivotal year for stablecoin and DeFi regulation. The frameworks are forming. How they land will shape what these products are allowed to do and how they have to disclose risk. That's not a reason to avoid them, but it's a reason to stay informed.
Here's what this really comes down to, I think. We started this episode with the idea that your investing app might already be a DeFi interface, and that's not a hypothetical anymore. It happened on July 1, 2026. Robinhood Chain went live, Robinhood Earn launched, and millions of people got access to a 7% yield product powered by a protocol with $7 billion in TVL, whether they knew it or not.
And the compounding mechanics underneath it are genuinely different from anything traditional finance has offered at this scale. Smart contracts, reinvesting rewards continuously, lenders and borrowers competing in real time, capital flowing across Spark, Ethena, and Maple, all of it settling on-chain. That's not a savings account. That's a fundamentally different financial instrument.
But the risks are real: smart contract vulnerabilities, stablecoin reserve integrity, liquidity stress, regulatory uncertainty. Terra USD is the ghost in the room that reminds everyone what happens when the design is wrong.
And the actionable insight is this: the Galaxy Research Framework applies here. Don't just look at the 7%. Ask what you're earning for the risk and what remains after the complexity. Robinhood has reduced the complexity significantly. The risk is still there, it's just been curated and insured and packaged into something that looks like a normal app feature.
So the next time you see a yield number in a fintech app, you now have the vocabulary to ask the right questions. Where does the yield come from? Who are the borrowers? What's the stablecoin backed by? Is the rate fixed or estimated? And what happens if the market gets stressed?
Those 5 questions will take you further than any headline APY ever will.
We open this episode by saying the app on your phone might already be a DeFi interface. Turns out, for a lot of Robinhood users, it already is. They just didn't know it. Now you do. And knowing what's under the hood is the only way to decide whether to press the gas.